From the morning reading, Bank of America, Nike, Goldman Sachs lead Dow higher as the SPX pulls back. Apple closes lower, but above the open. 4 of 10 sectors moved higher on Wednesday. XLF, XLI, and XLU were the strongest sectors, while XLRE was the weakest sector. Oil futures fell 7 cents to close at 49.23. Breadth weakened compared to the prior session as decliners led 1927 to 1093 on the New York Stock Exchange and led 1889 to 837 on the Nasdaq. On the S&P 500 snapshot, the Tuesday seesaws and then closes lower. The S&P 500 started strong with a drop early in the day. The remainder of the day seesawed due to mixed earning results, closing just above the intraday low. The end of the day with a technical loss of 0.38% from Monday. Year to date, we're at a gain of 4.85%. The yield on the 10-year note closed at 1.77%, unchanged from the previous close. U.S. equity funds got punched again. There was a huge outflow from domestic funds that focus on stocks, the fifth largest since 2007. Total fund assets have grown over that time, but even if we express the outflow as a percent of total assets, it was large. There was a temptation to automatically consider such an outflow to be a contrary indicator and bullish for stocks, but the history of other large weekly outflows has been mixed. It's been a while since the last new high. The S&P's last 52-week high was on August 15th, meaning the index has gone more than 50 days without recording a high, despite being within 3% of one that whole time, an all-time record long streak. The other two times the streak exceeded 40 days, stocks jumped to a new high, then promptly fell into large corrections. Natural gas prices have collapsed. Since closing at a 52-week high a couple of weeks ago, gas has dropped nearly 15%. That's the 11th time since 1990 that has declined 15% within 2 weeks of a 52-week high, and almost always there was even more selling to come. If stocks are going to rally, then now should be the time. From the last 3 days of October through the first 3 of November, the SPDR has rallied 19 out of 23 years. It has averaged a gain of 1.6% with the risk-reward ratio that has skewed more than 2 to 1 to the upside. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:06 a.m. Mountain Time, and I am recording this in preparation for the market day of October the 27th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and get into our morning report. And I have gotten into the habit of forgetting to open these up. So get these over here. Sorry about this. I usually do all this beforehand. Last like 2 or 3 days I've not. There we go. So on our morning report, at the time of the cut, all 4 U.S. broad-based indices were up. The S&P futures were up about 1/3%. Russell futures also up about the same, as are the Nasdaq futures. Dow futures up slightly less, a little less than 0.2%. Crude is up about 1/3%. Euro's up less than 1/4%. Bonds are down about 0.6%, and gold is up about 1/4%. In overseas action, China just a bit below scratch. Hong Kong down about 0.75% or so. Japan down about 1/3%. Germany and United Kingdom down just below scratch. Pretty good slate of macroeconomic events, as is typical of a Thursday. The important ones in the United States are core durable goods, the weekly unemployment claims, pending home sales, nat gas storage. Looking forward to tomorrow, we have advanced GDP and employment cost index and University of Michigan consumer sentiment. So we're going to round out the rest of this week with a pretty good slate of macroeconomic reports. In terms of current volatility conditions, short-term VIX is up a bit, but still relatively low at a 12.58. You have skew less than a 125, so benign. IV percentile on all four indices remains relatively low, with the S&P at a 28, the Russell at a 24, the NASDAQ at a 23, and the Dow at a 27. In terms of standard deviation moves, we did have one put in yesterday with the Russell at a -1 standard deviation moves. The other three markets continued their trend of very low close-to-close activity. In terms of the current charts, we'll focus in on the S&P. Towards the relatively low end of the range of late, though so far today we're going back up. So it's just really this more of the same, this finely balanced, neutral, largely action. And here you see the moving average lines, the cloud. I mean, everything is just kind of stacked right on top of each other. The horizontal support that is so key down here around 2100 continues to hold, and yet we don't actually achieve anything to the bullish side either. You note that we have this overhead diagonal resistance, but more important, we have significant overhead horizontal resistance, and those are still also into play. So quite a bit of resistance and support in the general area, and yet nothing yet to have broken us out of this pattern. Same thing on the Dow, really nothing to focus on that it didn't say about the S&P. In terms of the Russell had a bit more negative action, and yesterday, literally came right down and touched the horizontal support practically to the penny, and the overnight revisited that area, both times bouncing off of this 1199 area and moving up from there. So, exceptionally weak, and yet at the same time, the bulls have demonstrated that they are able to hold support when challenged at that level. So until that support breaks, it is support. And so I kind of feel, frankly, at some point it's going to break, but it's still holding. So we have to give it that much respect. The NASDAQ, we also have had something of a pullback. You get an intraday new 52-week high and then reject all the way down into a pattern that's, I guess at the very least, is a bearish harami, which gets followed through. And then today's action thus far, totally reversing yesterday's action. So NASDAQ is also kind of churning around, albeit from a relatively much more bullish posture. And then we have on our other markets, let's take a look at crude oil. And you see it's been flirting with breaking down below this key support area, but has not yet decisively done that. Certainly we have hooked up under that support area, but right now price is trading right on the support. In terms of gold, gold has been in a sideways consolidation pattern and continues to be so. Very much the same has been said of bonds of late. Short-term action's been more bearish. 3 of the last 4 sessions thus far have been negative, but when you add it all together, we're still just within the range of the last couple weeks. And then from a volatility standpoint, also they're just sideways consolidation, nothing really to get excited about. Let's go ahead and take a look at the dollar. And the dollar has been in something of a short-term topping pattern, so but not decisively breaking down from that pattern either. Right now, frankly, you'd have to say this just looks like a bull flag on the dollar. And, after a big run up like you saw here, that you'd get a little bit of consolidation and then an expectation that it will continue to run to the bull side. While extreme in the dollar move, especially related to a currency, this is about a 2 standard deviation move, depending on the time frame that you look at. It certainly doesn't seem to have said that it's over quite yet. So that certainly is weighing on all those other charts that we just looked at. Let's take a look at our daily report. Still market phase 5. We've had that break of diagonal support, but not yet the break of horizontal support. Our 3 market timing signals still pretty much in the same position. IBD, the first signal, uptrend under pressure, certainly a cautionary signal. GMI index, 2 out of 6 with a sell signal in place since 10-12. And then the stock charts decision point scoreboard, we had the one short-term improvement joining the prior day short-term improvement on the Dow, but overall still quite mixed with a lot of neutral to bearish and then neutral to bullish, and kind of mixing us all together into a basically stalemate kind of situation. Overall, the intermediate term is also neutral to bearish, and then mixed signals on all the long term. So when you put all this together, finally balanced, and I would like to think that this is probably with a bias to the downside, given that this is cautionary, this is an outright sell signal, and this is finally balanced. And we'll probably be conservative in the read and call this neutral to bearish, a slightly bearish bias. Position sizing opinions, currently 50% and 75%, no change from yesterday. We do continue to see chop and lots of signals going back and forth in the intermediate term market posture. Right now, the S&P is signaling a strong bear signal. This is reinforced with a weak bear sentiment line. So you see this first day strong bear on the S&P. We have a weak bear on the NASDAQ and a strong bear on the Russell. If this drops below 20.0, that'll go to a severely strong bear on the Russell. The only thing that's holding up is a weak bull signal on the intermediate term market posture for the Dow. Hedge warning status remains level 1 plus, caution with some elevated conditions. And the strategy opinions, I left them the way they were yesterday, even though the intermediate term market posture has flipped over, recognizing that these are flipping back and forth, and the overall position on the charts and so forth are still the same. So we're still very, very conservative in all 3 of these opinions, still allowing for the initiation of some limited new positions for the novice traders, but they should be definitely constructed from just the best of the best setups, and with very, very conservative construction with 2-to-1 ratios in the money and out of the money strikes and the covered calls, 2-to-1 ratios, low beta versus high beta positions. Put selling should be considered with spreads and in the position size you are willing to own. We're starting to see more red show up in the volatility-based warning area. Our ratio warning fired 2 sessions ago. The daily squeeze is present and ready to fire. Now, I'll have to give a caveat here. I put this in red, but the fact of the matter is it can persist in this squeeze environment, ready to fire for prolonged periods of time, and we could very well see just that with the election some 2 weeks away. Distribution day count continues to be high in relative terms. Anything over a 5 is a warning, and now the NASDAQ and the S&P are both at a 6. In terms of the current 10-day expected move, I also put this to red. At the 10 days right now, it's still below 40, so that would technically not be a warning. But the election is just beyond the 10 days out, and when you go to like 12 and 13 days out, it pops to well over 50. So we're about to see an expected rise in volatility come into view in our relatively short-term period. So I thought I would at least make mention of that. In terms of trend-based warnings, we still have that market phase 5 and now the strong bear. And then also the New York Stock Exchange, new highs, new lows. Yesterday went well above warning status with 413 to the downside. Then you throw on top of that the key intermarket risk aversion indicators, with all 5 of them being currently essentially in a risk-off stance. This is starting to be, as we say, change and rate of change, quite a bit of red in these individual warning sections. Fear and greed index and other sentiment indicators are in this kind of neutral to slightly to the fear side. Not terribly extreme, but certainly to the negative side. In terms of the sector-specific information, you see that with Wednesday's performance, you did have some performing sectors and a bit of a mix of high beta and low beta, more defensive-oriented. You got utilities here, fairly good breadth to the positive side, energy the same, but also financials and industrials. Financials probably the most consistent performer in recent days to weeks. In terms of some of the ones that were getting hit the hardest, healthcare continues to get pummeled. I don't know if this is related to perhaps an expectation of election outcomes or if there's something else going on, but healthcare certainly has been struggling as of late. If you're going to say that financials have been doing well in the days to weeks of late, healthcare has been probably one of the more consistent to the downside. Information tech has been generally performing pretty well, but had a bit of a down day yesterday. Also, real estate on the downside. So kind of interesting that you have real estate as so negative and utilities as pulling out a positive with pretty good breadth yesterday. So those are both generally considered to be interest rate sensitive sectors, and yet they went in different directions. So we don't normally see those in contrary directions. In terms of sector-specific market postures in the short to intermediate term, it's not quite a sea of red. We certainly have a lot of bearish and neutral signals. Probably the more interesting thing is the lack of green, and really only financials holding up in the short to intermediate to long periods as consistently in the upside. Utilities have been improving, and this signal right here was right on the cusp of going to green. So we will also recognize that utilities has been on the move and an improving market postures. In terms of the percent change yesterday, we continue to see a lot of red here in the 1 day through 3 month periods. With financials, again, we talked about how they've been the most consistent, and in all 4 of these first time frames is representative of green, the only sector to do so. Though information technology, which fell back a bit yesterday, has generally been positive as well. Well, that should be enough for today. Let's go ahead and wrap up. One thing I will mention that we do send out a very limited number of emails. When I write a blog article, sometimes when I get a hedge risk level change, if you'd like to be on the email distribution, just go to this email address, go to this hyperlink here, and then once you're on that page, roll down the page just a little bit. You'll see this button. Click on that button. It'll ask for your first and last name and then your email address. That'll get you put on the list, and that'll also get you a hyperlink for a copy of my ebook about portfolio strategy. Also, you can do the same thing through your smartphone by texting Falcon Global, all one word, to the number 22828, 22828. I'll just scroll through the rest of this today. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here for the next market preview from Falcon Global for tomorrow's session. In the meantime, manage that risk and watch everything pretty much fall right into place. Go learn something and have a great day trading.